Well, it's been a while since I've discussed the financial markets, and I've had a pretty negative outlook for most of this year, and I still do. Obviously, when you're playing the Bears side, it's a waiting game, and you're always wrong until you're right. And so, of course, anyone who's on the other side of that is going to say, "Oh yeah, broken clock's right twice a day." At the same time, anyone who ends up being right on the Bears side can go, "Oh look, I was right," even if they, the way that they were describing, why things were going to get bad had nothing to do with, what ended up actually happening. So it's very difficult if you're playing, if you're taking the bear case, to really differentiate yourself and not sound like an idiot. Because either, it takes forever for what you say to happen, and everyone just says, "Oh, yeah, you were saying that for years, so eventually it happened." And at the same time, there are a lot of people who are completely wrong in what they say is going to happen, and then when something bad happens, they just take credit for it anyway. And people aren't smart enough to understand that had nothing to do with their original argument. And so I realize that the more I talk about this, the more I end up, opening myself up to ridicule and, perhaps, what I would consider unfair criticism. But nevertheless, things are pretty crazy out there on Wall Street, and I think anyone who thinks that we're living in normal times is deluding themselves and, is just not looking at the facts. And anyone who thinks that, what we've been seeing for this past year and, before that, but especially this year, if they think that, this bodes well for the future of the equities markets, I don't know what to tell you. I don't, maybe we're looking at, different sets of headlines and things. Perhaps there are some people who only focus on the trade optimism, because frankly, that's what seems to have been driving the markets for this past year is all trade talk optimism. But there was a time when, stock prices were driven by a little thing called the fundamentals, meaning, like the health of the companies, whose stocks are traded in, New York. The companies that make up the S&P 500, the 500 companies or whatever it is. It's not exactly 500. I forget the exact number. Or the 30 companies that make up the Dow, or the however many make up the NASDAQ. How these companies performed, on a quarter-to-quarter basis used to be what mattered. That used to be, what drove prices. And because, if you think about what stock prices are, they're the price of owning these companies. You would think that the better performing, the more, profitable a company is, that would drive their price up. And that if a company, became less profitable and wasn't making as much money, that would drive their price down. That's how things work in a normal market economy. Believe it or not, it is possible to have a stock market that is, healthy and, relatively free and productive. And so if you look at earnings growth and the S&P specifically I'm looking at today, the S&P has been in an earnings recession for 3 quarters in a row now. Okay? That's not a very good thing. That means that companies overall, if you average all the companies in the S&P, they have been making less money. They are not doing well. Okay, as Al Gore would say, corporate America is sick. It has a fever. Year over year in the third quarter, the S&P companies, their earnings are down 2.4%. Now, that's not huge. It's not down, 50%. It's not like these companies are collapsing. They're not going to go bankrupt tomorrow. But, this is not something that would drive the price of stocks higher. This is not something, this is not a headline that you would think would accompany, the headline that, the S&P is at all-time highs. You would think that, if we're down 2.4% year over year, that perhaps the price of stocks would be lower than they were, last year. Because these companies are earning less money. You would think they would be worth less money. I mean, this is not hard to get across to people. I don't think that this is a particularly, opaque point I'm making. But, if you are someone who's looking to buy a company, are you going to pay more money for a company that makes, let's take 2 companies. One company makes, $1 million a year, and the other company makes $1.2 million a year. Okay, these are small businesses in your town. Are you going to pay? Which one are you going to pay more for? Are you going to pay more for the company that only makes $1 million or the one that makes $1.2 million? Obviously, you would pay more for the one that makes $1.2 million. So if you had a company that last year was making made $1.2 million and this year only made $1 million, you would think it'd be worth less because it's earning less money. But unfortunately, that's not the way that the stock market works in America. The way the stock market works is that stocks go up every year with no risk, and there's just these little dips, and every dip is a buying opportunity. No price decline is ever natural price discovery, but every rise in prices is very healthy and totally legit. And it's the responsibility of the Federal Reserve and the federal government to ensure that stock prices do always go up, because that's what America's all about. So you might be asking, why is it then that stock prices are at all-time highs, if in fact that all these companies are making less money than they were a year ago, and they've been in decline for this entire year. The first 3 quarters of this year, we've been in an earnings recession. So you would think that stock prices would fall. They haven't. So why is that? Well, the Fed is pretty much the only answer. What's changed this year for the good, from Wall Street's perspective, is not that companies are making more money. Like I said, companies are making less money. So there has to be another factor there that they're taking into account that overpowers, the declines in earnings over the past year. And that factor is Federal Reserve policy. The Fed has completely switched. At the beginning of this year, they were saying that, we're going to let our balance sheet run off, which is a nice way of saying that they're dumping treasuries into the open market. They're increasing the supply of U.S. government debt that is for sale. And the Fed was planning on raising interest rates. Well, that's completely reversed now. The Fed has cut interest rates at every meeting. Well, not every meeting, but they've been cutting it for the last, few meetings. And they're going to keep cutting until they get to zero. They've made that abundantly clear. The Fed is going to keep cutting and cutting. So we're going back to 0% interest rates. And the Fed has gone back to quantitative easing, which is a nice way of saying that the Fed is just dumping money into the banks. And they're, buying up their assets and injecting cash into there. And, now the banks are flush with cash. And so now that there's all this cash injected into the financial system, well, where are they going to spend it except, on equities? Because nothing else has a decent yield. You're not going to put it in, bonds that are making negative real yields? No, you're not going to do that. You're going to put them in European stocks that, don't make anything? No. You're going to put them in Japanese stocks that make less than nothing? No. So you're going to buy American stocks because that's the only asset in the world that really appreciates. And so the reason why people are buying stocks now and driving the price even higher than they were a year ago when, these companies were ostensibly worth more money because they were making more, is because there is no other alternative. There's all this cash floating around the system. There's all this liquidity. There's all this debt, and they've got nothing to do with it. So they have to dump their money somewhere, and so they're dumping it in stocks. And most of this, from what I understand, because the mechanics of this are quite opaque, at least from my perspective, how exactly the transmission mechanism works from getting the money from the Fed and then into the real economy. It's pretty clear that, once, the Fed turns on the tap and starts, pouring the sweet liquid, the sweet liquidity, all this money into the system, that it doesn't make it down to, ordinary people. That's pretty clear if you look at, changes in wages over the past few years. Those haven't gone up very much. What has gone up are asset prices. So this is getting, the money. We understand that the money flows into the top and stays there, but I don't understand even within that how the money moves around. Because from what I understand, some people argue that most of this, these increases in stock prices are not directly as a result of quantitative easing, but because of people speculating about quantitative easing. In other words, this is not the QE money that's pouring into the stock market. It's people saying, looking at the Fed printing so much money and saying, wow, this should have some kind of inflationary effect, so I should buy stocks because stock prices are going to go up because of the QE, but then the QE money doesn't actually make its way, at least not a ton of it, doesn't make its way into the stock market itself, except for, in like buybacks, because, all this QE money going to the banks allows corporations to get cheaper rates on borrowing money, and then they can borrow money and buy back their own stocks, and that drives their stock price higher. But other than stock buybacks, I don't see how this QE money directly flows into the stock market. Most of it seems to be people speculating about how QE is going to affect the stock market. And so right now we've got, another speculative bubble that's been blown just this year on top of the already existing massive asset bubble that the Fed has blown up since, the 2008 crisis with their previous rounds of quantitative easing. And the price of stocks seems to have become completely detached from the fundamentals, from reality. Stocks don't seem to move much in relation to the way that the way that earnings move. The stock prices don't seem to be tied so much to the companies that are being traded here, but really it all seems to be a part of the Fed's big game. And so then the question becomes, when does all this end? Because, people like me, we've been saying for years, oh, this isn't sustainable. This isn't natural. These prices are not real. These are fake prices. Well, at what point does it stop? Does it really matter if these prices are fake if they keep going up? Because obviously they're there. You might not say that those are honest prices, that those are what things should be in a free market. But hey, as long as we don't live in a free market, what does it matter? What the free market price of a share of Microsoft would be. Well, it matters once the bubble bursts. And so everyone wants to know when that is, because, we say this is unsustainable. It isn't. Yet here it is. We're here, over 10 years after 2008, and, this next bubble that they blew up to replace the 2008 bubble that burst is still with us. And the answer to that question, I don't think, a lot of people like, especially the doom porn crowd, the folks that just, want to hear about the apocalypse coming imminently. I don't think that it's going to just go poof and disappear all at once. I think that we're going to have a very slow decay. I think that we're going to see, the decline and fall of U.S. equities, not just a sudden collapse. And in fact, I think that this will be accompanied by a decline and fall of the United States itself, because I don't see how you can detach the health of the United States, of the regime, from economic prosperity or supposed economic prosperity. I guess economic optimism is really a good thing. People need to feel like they're rich. People need to feel like they're getting paid dividends by being American. And for the most part, we kind of are. Even though I think that what the Fed and the government does is really negative on net for Americans. If you look at how we're living compared to other countries, we're getting a pretty good deal. With the massive trade deficits that we run every year, America imports more than it exports perpetually, and we're going to keep doing that as long as this game goes on. That's a part of the bubble. America has been violating Say's law for, 40 years now, since the 80s under Reagan. Say's law, which, John Maynard Keynes tried to debunk, he can't, because he strawmanned it, and, Say was long dead by the time that Keynes made his argument. But, in the real Say's law, the non-strawman version, is that, you can't consume more than you produce. You have to, you can't, the problem in an economy is not that, there isn't enough demand and that people aren't consuming enough. No, the problem is that people don't produce enough, because, you can't just consume more than is being made. Yet in America, we do that. We consume more than we produce every year. We're able to do that because, we export our inflation, all this money that the Fed prints every year. It doesn't stay in America. It doesn't drive up prices here. It goes outside of America and gets used in other countries. The U.S. is able to buy imports from China and pay for it in dollars that we printed. We take money off the printing press, hand it to the Chinese, and they give us stuff that they actually had to work and produce. And so the Fed knows that they can't turn off the tap, because that would lead to massive social unrest. Because if the Fed suddenly stopped, trying to pump more air into this bubble, and if they let it start to deflate, let alone pop, well then, quality of life in America is going to suffer. And of course, the much bigger problem for them is not just what the normal people think, but all their billionaire friends, people like the kind of people who are on the Fed board, they're going to start losing money because they own, so much in equities. And that's why Powell has, said repeatedly that he is going to do whatever necessary to sustain the expansion of the bubble. He didn't use the term bubble, but that's what he said, sustain the expansion. because they've made it clear that they're not going to allow a recession to happen again in our lifetimes, as long as Powell is in power. Well, then that just means that they're going to expend every ounce of capital that they have. Figuratively speaking, of course, because literally, the Fed has an unlimited amount of capital in that they can just keep printing dollars. But they're going to keep playing these games like QE or whatever and trying to manipulate prices and get them further and further detached from reality, because we can't have a reset to where, prices revert to their natural, state. And so the way the Fed does this is by creating more and more debt. So what we're going to have in this country is, people becoming more saturated in debt, and things will get, deeper and deeper, and that's what we've been seeing. The household debt to GDP ratio, I think, has never been higher. Credit card debt is exploding. This is exactly what the Fed wants. And the end game of a policy like this, we've seen it before, really in two places. First Japan, and now in Europe, of a central bank that just won't let a recession happen. What you end up with is stagnation. You get, a point to where prices just become numb to the economy, and that what happens in the real economy no longer matters. You get, I guess, a zombie economy. Because that's what Japan has. Japan hasn't grown since the 90s. They stopped growing after the end of the Cold War. Europe really is not growing. They're not going. They stopped growing after 2008. And America is going to be in the same boat here. We are going to stop growing. There might be a slight pullback, some kind of crash like 2008, but not that bad, not as catastrophic. And I know I've made fun of people who say it's not going to be that bad. My point is that the Fed will do everything they can to make sure that the crash is not as bad as it should be. Okay, so if we had a crash, and a proper crash, it would be far worse than 2008 because there's so much more bad debt built up in the system. However, the Fed has made it clear that they don't want any of that to happen. So any fires they see, they're just going to dump more money into it. They're going to dump more debt, and they're going to just keep blowing up the system more and more. And so, we're essentially the economy is full of tumors, and all these tumors are bad debt. And the only way that that the Fed knows how to fight cancer is with more cancer. And so what I see now is that the last place on Earth where you could get reliably positive returns on your investments, the United States, I think that that's going to go away, and that we're going to end up just like Europe and Japan now. But I don't think that the U.S. can tolerate that, because we Americans are accustomed to a much higher standard of living than the rest of the world. And I don't think that stagnation is something that will, have positive social ramifications, in America. I think that, it by itself, even without a crash, that stagnation could lead to perhaps not, civil unrest, but increased tension in America. I mean, things are going, I don't think things are great right now, but by most people's, accounts, things are going pretty well right now. And, America is kind of at each other's throats. And so if we start walking down the path of no hope for growth ever, of, increased stagnation, of, no more rising wages ever, no more, you're going to get to a point to where, your kids at best will live as good of a life as you did, but probably a worse life. Meanwhile, the Fed is working overtime to make sure that, the bankers and the billionaires don't lose any money. I don't think that this is a good long-term strategy, I guess, for the U.S. elite. I think they're between a rock and a hard place. If they don't try and, prevent a crash, and they actually let the crash happen, which is what would happen if the Fed, took their foot off the gas right now, because the only thing keeping this market afloat is the Fed. Everything else is bad. There's no way around that. The data is not doing great. There's no reason for this market to go up other than the Fed. However, if they didn't make the market go up and this big crash happened, then nobody would trust them. They would lose their credibility. They would look feckless. So malaise really is the best. That's the best idea they have at this point. We are going to enter a period in which things just sort of mellow over in this country, but not in a peaceful way. Not in a way that people are going to mellow in their attitudes. People are going to mellow in a bad way. Kind of like in the sense that an idle mind is the devil's playground. Well, people who are not, working hard and don't, and can't find enough work and are, hungry for some sort of progress in their life, people are going to get frustrated and angry. And I think that society will become increasingly divided, and eventually this whole charade will come apart. I'm not exactly sure how. It might be, 40 years from now. But when it does, I don't see how anyone's going to put Humpty Dumpty back together again, because all the debt, every year that goes by, there's more and more bad debt that just gets built up in this system, and I think that any collapse at this point is going to be catastrophic. We're past the point to where we could just let the recession happen and let everything reset. We're way too deep in this now. We're in the stage where they just have to delay. And so the best that we can hope for at this point is, I guess, that things won't get worse yet. They'll get worse eventually, but they certainly won't get better. What we're looking at right now, this is as good as it gets. But pretty soon, some people would say it's happened already. The consumer is going to be tapped out. They're going to be overextended, over-leveraged. And, consumption, which by all accounts is what's holding up the economy, believe it or not, as ridiculous as that sounds, you're going to see that take a dip too. And I don't know what the Fed's response is going to be then. I don't think that at that point, when consumers just are overloaded in credit card debt, and people need a reset, when you need to have a national bankruptcy, I don't know, how they're going to deal with that. But hey, they've overcome my expectations so far. So I think I'm just going to wait and see and watch what happens. So if you get anything of value out of this video, I'd appreciate you clicking that like button and sharing this video. And if you haven't already, please do subscribe, because I do upload every day and I'd hate to have you miss one. So I'll see you folks back here tomorrow.